So Rob was here in Raleigh back, it was 8 years ago in 2013. And I think he was relatively new after having taken the leadership over of Bright Trading. And I remember we got together afterward, and I remember the dinner. But more important, he's had a great career with, first of all, with I guess Paris Co., which was his own proprietary trading company specializing in Paris trading, an education company, and then Bright Trading, which was an already well-established proprietary trading firm, hired him to run that firm. And there are a lot of proprietary trading firms around, and there have been for many years, but none of them, or very few of them, if any, have the reputation that Bright Trading has, and also very few, if any, have the concentration now, I guess, on systematic trading, which I think, and we'll let Rob contradict me or agree with me, that he has particularly enhanced and emphasized in his leadership of the firm. And let's see, yeah, that's right. That's some of the things I wanted to mention.
Yeah, I can fill in a little bit. So if I'm good to go, sound check again.
No, it's fine.
Okay, good.
So I will hand it over to you.
All right. Well, yeah, I did start my trading career in about 1992, 1993, somewhere in there. And I was trading retail. And then in 1997, I found Bright. It was kind of an interesting, said no ticket charges, low commissions, things like that. So I said, oh, I better check this out. So January 10th of 98, I joined Bright. And then it was within Bright that I actually created Paraco. We ended up sponsoring over 40 traders, putting up our own capital and helping people get started and sponsoring. And then we had to sell that entity to Bright actually because of regulatory complications, that things that needed to be looked after, and it was just not manageable. And so since I worked with Bright in developing many offices and had some top performing offices, probably largely pair trading was the contributing factor. In fact, when we hired our compliance officer who used to work from the Philly, she said that she saw real merits because she had audited a lot of trading firms, and she saw real merits to long short trading, pair trading, just being hedged in general, at how much better the traders would do on average than what she saw at other firms that didn't utilize those tactics and strategies and methodologies. So that was really a nice confirmation that we were on the right track and doing things that would kind of turn into a career for traders, right? We wanted them to have the best odds essentially of making a living. And we consider, if you're going to be involved in trading at all, you should be making, 50,000 a year minimum from your efforts. More so if you're full-time, and maybe less so if you're part-time, if it's just a side hustle. But you need to really turn it into a business, into a career. And I think there's a lot of fallacies and bad approaches out there in general that cause people to have it more like a hobby, a game. They're playing a casino game essentially, that and on the wrong side. They're not the house. So I want to help traders, regardless of whether they're with our firm or not. I want to help traders improve their ability to earn money from the market, not just win the odd trade here and there, but really earn. And so as Don said, 2013, I had the opportunity to take over as president and chief operating officer of Bright Trading. And so I've continued to work at trader support, onboarding, developing strategies, developing data, things like that. And compliance asked us to sort of separate data and education from the broker dealer. So I have another company now that I'll introduce you to that where you can, that's the picks and shovels side of the business. So Right Trading just focuses on being a vehicle that clears through Goldman Sachs. We execute and clear through Goldman, and they're just the vehicle for you to use for trading DMA, direct to the markets, as well as use Bright's capital for your trades. So proprietary traders get to put up a small risk deposit. At the time that I was in Raleigh, I think our minimum was either 25,000 or might have even been 50,000. Because of some of the success that we've had with traders, I've been allowed to start a program for people to come in with as little as $10,000 to $15,000. And so if you feel that you're handicapped because of the pattern day trader rule, or you just don't have enough capital to do what you want, if you join Bright with 10 to 15 grand, you could use 300,000 during the day, that kind of thing. So we provide a lot of capital, and as we get to know you and you build your account, you'll be soon using $1 million worth of Bright's capital for your trading. And so you can do a lot more with that than you might do in your retail account, especially if you're constrained by some of these regulatory things. So we don't have Reg T or portfolio margin. That's not applicable. You're simply using the firm's capital every time you trade, so every day you get to use that capital over and over again as much as you like. And there are obviously some rules and parameters, but I think I have traders that have been with, I joined in 98. I have a trader that's been with us since 1999, 2000, 2001. Some of those guys are still around and very successful. So they've enjoyed a full career, and the freedom that goes with that. So not easy, but they've been able to adapt through the different changes. So I'm going to share my screen here, and let's see, I'll share that screen there. If you're wondering what's behind me here, I built a treadmill. I got screens all the way around my treadmill, so it's like I get to stand up and trade and walk really slowly on the treadmill. That keeps I'm trying to fight old age to some degree, just keep active while standing up and trading, so, and working on all the business side of things. But right now I'm sitting down here, and so I would call this screen here, this is the S&P index today. So whether you trade the spiders or the diamonds or the Qs or the Russell, they all pretty much look similar. So I would say stop the madness, right? Like look at that chop after we had the slide, and look at all those false starts. People thinking it's going to rally back, and only to, as soon as they by the time they bought it, they probably pulled back on them. So this is really frustrating trading for just people that are long only or one-sided and not trading relationships. It's very frustrating, and I know because I hear from a lot of people, and I have new people joining the firm, and so I know what they're struggling with. And so there's one thing that's in common with the top 10 traders at Bright. If I was just to take the top 10, they do have different strategies, right? There's probably 8 different strategies within the top 10, but there's one commonality amongst them. They're all completely hedged. Long, short dollar hedged all the time. Overnight, intraday, whatever, they're always hedged. And yet they make a great living. So don't think that you have to be one-sided and take a lot of directional risk in order to make money. You just have to trade, relationships. So if you feel that you're getting whipsawed and it's just madness out there, then let's stop that and let's find a better way. So as I was thinking about this, I kind of pulled up the presentation that I did back in 2013, just to see if anything's changed in terms of what I talked about then and what I would talk about now. So I'm just going to bring that up and go through a few slides, Don, if you don't mind.
No,
So
that's a very good idea.
This is the presentation back in 2013. It was June the 3rd or 6th, somewhere in there. I was in a few cities and Raleigh was one of them, right? So we were talking about hedge trading for uncertain markets and uncertain times. So the current markets back then, they've been influenced by the Fed and central banker policies. Has anything changed there? I don't think so. Money supply, interest rates, coordinated efforts, European money seeking safety. Well, I mean, money from outside, definitely European money with zero interest rates there. They're obviously looking for negative. They're at negative interest rates, not even zero, looking for some yield somewhere. And you always see this sort of like a little bit of flight to quality when there's other things happening in the world. Investors seeking yield. So again, in the last 7 years, these investors are still seeking yield. Part of the reason the market's gone up a lot. So from this, it may appear very predictable and bullish for the long run. So what happens after? Should we consider hedging now? So anyway, I'll skim some of this here. I don't want to get too much into it, but so the problem a lot of times is that you have to sit through that volatility of the market while you're trying to get your returns, whether you're short-term trading or long-term trading, right? It's stock picking, pretty tough, right? To pick the right stocks each day and stuff like that. We look at outcomes. You might be experiencing, that you're not getting the results. You really have to look at the process, right? Wrong thing, wrong results, wrong thing, right results. I've seen a lot of traders do the wrong thing and get the right results temporarily. What may end up happening is that turns on them, and it takes away. They have one day that takes away the last 20 or 30 days of hard work. So we can do the right thing and we can get the wrong results, or we can do the right thing and get the right results. So I want you to always try to do the right thing, but just because the results aren't there doesn't necessarily prove or disprove, right, the strategy or the methodology, right? So spread trading is buying a stock or ETF and selling short another stock or ETF against it, or you can buy a basket of stocks and sell short another basket of stocks against them. Pairs trading and basket trading. So pairs trading, the common household names are what people think of when you trade pairs. There's a lot of exotic relationships, like you can do common and preferred stuff. You can do supply chain. You can do MLPs, master limited partnerships, general partners. You can do class arbitrage, like no different than Google has 2 classes of stock. That's a pretty difficult one to trade though, because it's so pricey. But there are other ones, like Under Armour has UA and UAA. So you have 2 classes of stock in the same company. When things get really volatile and you need to sort of shift gears to really being defensive and trading something that's a lot safer, those type of class arbitrage, what we call contractual pairs, can really be the safer place to go. And when things are volatile, they actually produce not so bad. When things are really quiet and volatility is down, say below 15 on the VIX or below 12 on the VIX, then it's much more difficult to make a good living from those type of really efficient relationships, because you have to put so much capital on them, right? So statistical arbitrage is what we do. And in a sense, with basket trading, this is where we've evolved a lot since I was in Raleigh and talked to your team there, is that we've really built a lot more data and a lot more strategies around basket trading. And the reason that there's that sort of evolution is because, you know, with the way the markets are in terms of real liquidity when you're trying to get filled, and the separation between the bid and offer, we call a lot of slippage. And with the fact that, you know, it's hard in this market often to be right in a timely basis off of your charts and things like that. When you concentrate a lot of capital into one idea, you know, you're opening up the risk, you know, that you could really be hurt. And then it's so hard to come back from that drawdown. In order to change that, I've been suggesting for quite a while that you lower the size that you trade per idea, and you trade more ideas. So you go wider, and you make it on the aggregate. I had one of my traders the other day that I started on this process, and he only has like 15,000 in his trading account. So he's in one of these people coming in with a lower amount of capital. But he had placed $400 per idea and had 250 ideas. So think about that for a minute. Very small, like $400 only per idea, but he had 250 ideas, and he made himself 1,100 for the day. So it doesn't take a big bet on one idea to have a great day. You just need a positive expectation working for you across a lot of symbols. Well, how do you generate all those symbols, right? How do you make it so that you can go in there and, you know, grind away and you know, see that kind of benefit when you're only putting $400 into one symbol? That's not a lot. I mean, we used to have a situation with Bright that we could not trade, you know, below 100 shares. But that's changed, where now we can do odd lots the last few years. And it's been great because people can go in really small and trade 10 shares or 3 shares or 5 shares. But in order, again, to make a living, you've got to then tackle a lot of symbols, or you got to be in and out of those symbols, you know, frequently in order to grind out some money. Okay. Obviously, the purpose of everything that we do in the markets is to make money. And if you know, you're not here to do that, then it's just a hobby. But for most participants, it's to make money. So there is, you know, some themes that I think have contributed to traders' success over the longer sample. And a lot of that has been by lowering risk has actually increased returns, by being hedged, and also by just, you know, working at the same thing and just, you know, Kaizen, a continual state of improvement. Just get better and better and better at what you do. Don't jump around to all kinds of things. So, you know, if you choose pairs trading, well, then get better and better at your combinations of long and short pairs, and do more research and get your timing better, and you know, get some production going while you're holding the pairs as well. We call it trading around a core position. And yeah, with basket trading, you might be trading it in a swing trade fashion, similar to pair trading, or you might just be trading it open to close. I have a lot of basket traders now that just simply put their positions on at the open of the day for the core session, and they take them off for the MOC, the market on close. So they're just simply placing their orders for the open. They get filled. If they're doing limit orders, they get filled on what they get filled. If they're doing market orders, obviously they get filled on everything. And then they take it off at the close of that same day. So they hold nothing overnight, no overnight exposure, no risk, that kind of thing. So again, lowering risk is the key. and having returns not dependent on the market direction and not adversely affected by market corrections. So we've had a pretty bad September in terms of the market stopped finally going up and kind of started to have some corrections, and a lot of tech stocks are down a lot. But my traders have had, fabulous days. One of my more mature traders it was on the last trading day of September, the down day that we had on September 30th. I mean, he made $100,000 in one day, just trading baskets, exactly like I'm describing to you. So that's someone, that's been around for a while and doing it, really on a significant level. But you have to get there by, $50 at a time, if that's what it takes. But the key is what I'm showing you here. And I showed that to you in your group back in 2013. And it's still the same. And anybody that's not taking that heart to heart about lowering risk and trying to get strategies and stuff that's working, that's not affected by market direction, or these types of corrections. Now, granted, we haven't had a lot of down moves in the market other than, in March of 2020 with the COVID crisis. But I mean, you could have been caught in that and, given back a couple years worth of hard work. If I don't know, maybe some people were, but, through that nothing really changed for basket traders other than using the macro to your advantage, but not sort of being impacted by the fact that it was a down day or when it reversed and it was an up day. So how does it work? If the trade is going to work out, so this is whether you're trading pairs or whether you're trading baskets, the long will have to outperform the short. Both stocks go down, both stocks could go up. One stock could go up while the other one goes down. You make money on the relative change. So everything we do is about relationship-based trading or relative value arbitrage or relative performance arbitrage. It's all about that relative change in long dollars versus short dollars. So I might put on, 100 symbols long and I have 100 symbols short. Or I could have 100 symbols long and I could have the spiders short. I could have 100 symbols from long from the Russell and short 100 symbols from the S&P 1500. I could have, there's so many different ways to change it up based on what the market's giving you, both the risk on versus risk off, the sentiment, the news, So just a simple example today would be if you were simply long smaller market cap stocks and short larger market cap stocks, you would have and hedged dollar for dollar, you would have had a return just on the S&P 500 of about 0.2% return on capital. So basket trading can take all kinds of forms. There's so many things that you can do, but there's some common principles, and we can get into a little bit more of that. So relative value arbitrage, relationship-based, research-based. You can use one method or you can line up some ducks. You can also have a fundamental foundation, technical considerations, statistical information. So this is the area that we've really ramped up a lot since I met with you guys in 2013, is just using a lot more statistical information, just becoming more and more quantitative. But these other things still apply as well. And anyway, so that was some of the stuff that we looked at when I was with you. So I'll stop there and move on to other things. Okay, so first off, this is the website that we have for, like I said, the picks and shovels side of the business. It's kind of education and data combined. So what I'm trying to do is I really want to teach people how to fish Then I want to give them the rod and the reel, the line and the tackle. And then I want to walk them down to the lake and say, hey, here's where you're going to fish now that I've given you some tools and shown you how to fish. Here's where you're going to fish. And by the way, I've stocked the lake with fish for you already. So that's the data. So it requires education in order to really make the most out of, you know, basket trading or even pairs trading. I mean, it's not everything about it's completely intuitive. Many things are actually counterintuitive, or many things are, you know, contrarian or mean reverting, things like that. So you need a bit of education. You need a proper framework in order to exploit an edge. In order to use edges in general, you need a good framework for it. Whether you were, you know, harvesting, you know, market gaps, or whether you were harvesting dividends, or you know, you were trading breakouts, or you were scale trading, whatever you're doing, it still requires a framework, a good set of parameters. The way that I look at trading, maybe this will help some people's, you know, understanding of where I'm coming from and why this is, because this is obviously quite different for many. You guys might be more advanced in this than a lot of people I talk to, but the way I look at the market is as if you were running a factory. You were a factory owner, and maybe you were making, say, you know, wooden ducks or wooden shoes, whatever. Let's start with wooden ducks. So you're making wooden ducks. So the goal, you put on one assembly line, the goal of that assembly line is to process as many ducks as possible. Like, you want to come out of it with, you know, being able to sell as many of those as possible to hopefully make a profit, right? And it wouldn't matter, like, if one of those ducks fell off the assembly line and got chipped. You just throw it in the recycle bin, and, you know, it can become sawdust or something, right? It's not a big deal to your assembly line. You're gonna try to process 50,000 ducks in a day, 100,000, 200,000, whatever your line can handle. It doesn't matter if one duck falls off it. That's how I see trading. If I'm processing a lot of trades, it doesn't matter if one trade goes funny. Like, I don't know any of my basket traders that use stop losses, because if you're trading small per idea relative to your account size, then if one of the stocks goes, you know, funny, it's not going to hurt you. It's not going to hurt the big picture. I mean, you can use stop losses if you want. I'm not suggesting you to do away with them in the sense that maybe some of you need that to protect your capital. But I'm just saying that many basket traders don't use stop losses because it's an aggregate amount of capital. It's not an individual concentration of capital. So if you wanted to add another profit center for your factory, you could put in another line and maybe make wooden shoes on that line. So you've got wooden ducks humming away. Now you're doing wooden shoes. And again, the same principle applies. So, like, when you're in production on basket trading, you might have one strategy initially. So you might be green 12 out of 20 days in a month. You add one more strategy, now you're green 13 out of 20 days. You add one more strategy, you're green 14 out of 20 days. And that's how you build this consistency, taking this career approach, running it like a business. So, like, that's the way I view it. Trading is very much production based. It's about earning money, not winning money. And it's about having a factory that you can process trades through and not worry about one trade going wrong. So you guys can look over that website later. When you get a subscription for one of the things that we have completely free here that you should start using sooner than later anyway, you just have to sign up with your email, but no credit card or anything, is the seasonality dashboard. So some of you might have been familiar with Stock Traders Almanac, also, Ken Show talks about CNBC bought Ken Show. They talk about seasonality once in a while, things like that. And there's the turn of the month effect and all these things that have been around for a while. So it's not like I made them up. They've been, you can get a lot of research papers on just turn of the month effect by itself, because it's a product of payroll deposits, 401k money, things like that. So we assembled this seasonality almanac, and you're all welcome to consume this on a daily basis and so on. I use seasonality for context. So I'll give you an example. We're going to go into October, and we want to look at, okay, what symbols are generally favored for the month of October. So you can look at it by the first trading day of the month, the first Friday of the month, mid-month seasonality, which is kind of payroll deposits in the middle of the month. It's the 9th through the 14th business day of the month. You have the third Friday of the month, which is expiration. You have the last 5 trading days of the month, last 3, and the last trading day of the month. And then we also have Monday, Tuesday, Wednesday, Thursday, Friday, and then monthly. So we can click on monthly, and you can see the symbols. And if you want, you can move the price slider, which will change the amount of symbols in the universe. You can change the volume. This is in millions of dollars of turnover. You can change that, and it will change this universe again, or the number of events. I would leave the events as is, because this is we're looking at it monthly. So we want to know what symbols are expected to perform for the whole month. So we want as many months as we can, and we've only got between 8 and 10 years of history in our seasonality, which is pretty relevant. It covers a little bit of Obama's years, covers Trump's years, and covers this year of Biden. So it's not too bad. So these symbols here are favored to perform positively, and as much as the percentages that you see for the month. These are expected to perform negatively, and by that amount for the month. So seasonality is what has happened in the past from close to close of whatever event or signal you're looking at. So this would be the close of September 30th until the close of October 31st, or whatever business day it is. That would be the what's expected for these symbols as a probability on average. So the odds are of going down. So this symbol here has 100% odds. That's pretty amazing, right? 100% chance of going down, as much as almost 20%. There's been 9 events that, it's just had since it came on the scene here, it's had a bad October. Whereas some of these ones have performed well. So when you look at this, you want odds over 50 for the green side, as well as odds over 50 here for the red side. So it's odds of going down, the higher the better. Odds of going up, the higher the better. Okay. So again, you can also flip to ETFs and see which ETFs are favored. So it looks like banking is favored for the month of October. We've even got airlines and some GDX, some of the gold juniors and the seniors. Oh, well, there's an ARK fund doesn't seem to do too well for October. Well, it's already started out. All the ARK funds have started out pretty bad already. But anyway, that's normally what we see for the symbols and the ETFs. You can flip to the next page as well, and you can see just everything kind of at a glance. And this would be the IWM, which is the Russell 2000 ETF in black, and the SPY in blue. So you can see that October is not expected overall historically to be a down month. It is a volatile month, but not historically, not necessarily a down month. So it could bounce back from its recent sell-off here. We never know. Again, just probabilities. And then you can put in here and say, okay, well, how does gold, how do you just type in your ETF here that you want to follow? And how does gold do relative to the SPY for October? And you can see that it's not expected to perform as well as the SPY for the month. So then we have here, what's expected on the first trading day of the month, the first Friday of the month, which in this case, the first day was also combined with the first Friday. Here's mid-month seasonality. So if I typed in, say, SMH, semiconductors, they don't usually start October on the strong note, but in the middle of the month, we get good seasonality for semiconductors. And then at the end of the month as well, the last 5 trading days, the last 3, and the last trading day of the month, they seem to do pretty well too. That being said, it looks like the mid-month seasonality at 1.58% overwhelms, all the other seasonality for semis. So I'll be looking forward. I'm be short the semis right now just because of my other statistics say to be short the semis, but I'd be looking to go long for the middle of the month here. Again, I'm going to be watching it on the 7th and 8th business day of the month, looking for any indication that we bottomed out or any indication of a turn, and see what the odds say for going into the 9th, 10th, and 11th business day of the month. I believe that starts next Wednesday, if I'm not mistaken. Let's see here. So 1, 2, 3, 4, 5, 6. Yeah, so starting on Wednesday next week, we'll be looking for mid-month seasonality to kick in. We could still have some more downdrafts or just real choppiness before then. So anyway, that's the almanac. If you want to see how the whole world looks, you can do that and say, okay, what does it look like for the 3rd Friday of October, which is expiration? Well, Europe's a little bit red, North America's green, Asia's green, Australia, things like that. So we have compiled a lot of information here for you. And again, completely free for you to use. If you do want to consume more of our starter package, we have these overnight vaults, which, overnight edge vault, whether you have an edge for a particular symbol that you're following, all these things are on demand, whether you have a price action edge for continuation of the price action. How about streaks? They're easy to understand when something is moved in the same direction for a period of time. And then if something's gapped overnight, let's say you came in today and you wanted to look at, well, Facebook was gapping down, say almost 2% pre-market. What is the expectation for Facebook then from open to close? So we put in Facebook here. Oops. Sorry, a bit slow on the interaction here. There we go. So we put in Facebook here. So it's gapped down. So this is now pre-market, let's say, and we say minus 2.1% or something that it gapped. And it's the pre-market indication. So that's the gap close of yesterday towards the open. And I said you can do this pre-market if you want, put it in there. And then it says for the day, the expectation is not for it to bounce, but for it to be down further from the open of the day session to the close of the day session. So that gives you some granular, perspective. And you'll notice that it's really funky in terms of the bins. These are all statistical bins, but you get, if it gaps up 2 to 2.5%, it pulls back. But if it gaps more than 2.5%, it actually rallies. That's why statistics are so important, is because when things perform at certain levels, it draws in, particular trading firms, hedge funds, investors. So there's different responses. And, I would have, prior to really digging into the statistics on this kind of level, I would have maybe colored it over with the same brush, meaning that, when something gaps up, it always does the same thing. And when it gaps down, it always does the same thing. But you can see how different that is. So moving on, we have reports, like if you like RSI2, it generates these reports for you to say, okay, when it hits an RSI value, say 7 or 2, or anything sort of under 30 is maybe oversold, what is it expected to do next, right? So you have your particular outcomes, again, similar like we looked at with seasonality, in terms of odds and average performance. So these are a really great way to get some quick ideas for trading. Again, we recommend doing some bullish ideas as well as some bearish ideas. So in this category of RSI2, it's projected 3-day return. So you can do swing trading with it and stuff. These are trending up, and the probability to continue with the odds that are greater than 50. And these are trending down with the probability to continue down with odds greater than 50. Whenever this date is updated, that means it's fresh data. So we haven't updated yet as of today for the 4th. So we'll need to wait for that to be the 4th before the data is up and ready to go. Let's see, I just refreshed it, see if it changes. No, we're still not up yet on that. So lots of dashboards for you to look at. They can be very, very helpful. And then moving on to our web screener. This is kind of like any other web screener. You can curate ideas. So I just want to run through what I like to do in a particular day. So I first go to FinViz and I look at, say, the groups, and I look at to see, how are the groups performing? Well, we know that energy's been strong on the week and as well as today again. Utilities a little bit defensive. You can see that utilities were performing the best out of the week so far, and that seems to be continuing. Real estate's doing okay. That's partly because of the 10-year yield as well. Basic materials had a bit of comeback. Consumer defensive. So I'll look at that and decide what groups I want to really focus on. And I go to, I want to be short some groups, and I want to be long some groups. So I'll look at this, and I'll look again in pre-market. So I'll show you what I do on that one. Where's my so this was pre-market today here. I don't know how well you can see that. Probably can't blow up a little bit here. Okay, so this was the pre-market before. I watched the 10 sector ETFs or 11 sector ETFs, XLB, XLC, XL. I just look at this pre-market and I make a decision whether I'm staying with my homework or whether I'm making some adjustments. So my homework is, again, in consideration of which groups have the money flow. And then I'm going to go and take odds on those groups. And then in the morning, I'm going to check to see if my homework aligns with what I'm seeing here and whether it's a risk on day or risk off day. So this morning, XLE, XLY, XLI, all performing already up a little bit. And you can see Facebook is a big component of XLC and XLK as well, performing poorly. the ARC funds, the semiconductors, you know, retail, all under pressure here, okay? Then if we look at what did it look like half hour before the close, this is the same theme here. You can see XLE still up. Now, XLU was not down too much pre-market and sprinted up. Gold kind of came up, real estate still there. So still very much in keeping with the homework from the night before, still very much in keeping with what we saw pre-market. And again, you can use this to your advantage, and I'll show you how. So we go now to our screener, and let's just take the S&P 500. I can go in and say, okay, what's my favorite signal that I want to use? Maybe it's %B. If you're not familiar with %B, it's Bollinger Bands. There's a lot of free resources on how to use Bollinger Bands. John Bollinger has a site. And %B is this measuring stick in terms of proximity to the upper band or lower band or the penetration of the band. So I could use something like %B and say, all right, I'll use the 2 and 20, which is default. I want to screen for what's the expectations for open to close the next day, or I could go close to close 3 days if I'm swing trading, things like that. So let's just leave it on open to close. So it'd be like, I want to have a signal from, so this is actually updated now. The dashboards are behind, but this is updated for the 4th. So we're going to be looking at opportunity for tomorrow. Okay, so signal and subsequent outcome. Signal and subsequent outcome. So let's explore that. So it says that when Agilent in the past has penetrated the lower Bollinger Band, and we put everything into statistical bins, so its last performance was down -2.32%. It penetrated the band. The odds are 53.3 of being up 0.1251% the next day open to close. So I could sort this by, you know, high odds. I could sort it by high performance. I could sort it by quality of the signal, various things that you can do. So even on McCormick here, consumer staples, it penetrated the lower Bollinger Band today. And the odds are 83.9 of it being up tomorrow. Good average performance, good Sharpe ratio, better favorable excursion than adverse excursion. And there's been 31 events where McCormick has fallen into that same %B. I click on here and you can see there's the signal, all the times that it penetrated the lower Bollinger Band and fell into that bin. And here's the subsequent performance and favorable excursion versus adverse excursion. These are all the dates that occurred. So you could go back and look at it on a chart and see what you think. So this type of data helps me. So if I want to be long consumer staples, if that's a favorite group, I've got a perfect candidate here to put into my basket. If I want to be, let's flip it to the other side. If I want to be short, maybe some, you know, industrials or some airlines. I've got a couple airlines choices to be short tomorrow if I want to. I've got Southwest. The odds are only 28.3. So now this actually hit the upper Bollinger Band, and the odds are actually of it pulling back from that average performance minus 0.81, which is significant for a one-day move. So it looks like Southwest might be a candidate for it to reverse that move today. Same with Fox Communications, right? Same with Adobe. Now, Adobe wasn't, up, it was down. But see, here's the thing. A lot of people make the mistake of assuming that what's down has to go back up, or what hits a lower Bollinger Band has to bounce, or what and here you have a clear case where this one did hit the upper Bollinger Band and its odds are favored for going down. So a short candidate. Whereas this hit pretty close to the lower Bollinger Band, right? And the odds are also of it going down. So upper Bollinger Band, pullback. Lower Bollinger Band, continuation down. You wouldn't know this. You would treat everything the same if you were just looking at charts. You would look at, oh, it hit this moving average, it hit this Bollinger Band, it hit this signal, and therefore, it has to work. Well, it doesn't, because every stock is unique in how it behaves, and our data reveals the characteristics of that, of those stocks and how they perform over the long sample. So we can export all this to a CSV file very quickly, and it brings it up like this. And then you can do what you want with it. You can sort it if you want. You can use it in a program, things like that. So simply put, I know we're going to run out of time here. What we like to do is kind of dial in terms of whether the market is risk on, risk off, or sideways choppy, what groups are sort of dominating. Like, I don't really want to, curate, let's say, for example, oil stocks when they're really in such demand and we've got a macro environment. If something said, hey, it hit the lower Bollinger Band and it, well, actually, or it hit the upper Bollinger Band and it's supposed to come down. And even if the odds said it was favored to come down, I might not short it. I might just stay out of that group altogether, or I might just find some good longs that are in that group, that the group is showing some strength. So this is a way to work in harmony with money flow and the other technicals that you guys watch, and be really data driven in your trading, be really statistically driven, to curate these ideas and put them together. So what it looks like after you do it, you might, let's see, you might sort it by average performance, let's say. Highlight that, say I want some really good performers. So, here's, if microchip, if it comes back from the dead, well, it's going to come back pretty significantly. Avco. So again, I'm not super thrilled about semiconductors early in October, but they have a lot of power based on what has happened. Massive down performance, penetration of the band, could be oversold. They could come back dramatically. I can make a list for a risk on environment tomorrow if their buyers show up and they want to buy this stuff. I have no problem, but I'm not keen on just presuming that semiconductors have to come back just because they sold off. In the various events in the past, when they did this, the performance was very good coming out of that signal. So the potential is there, but not the guarantee. Everything that we do in data-driven trading is probability-based, no different than your pairs trading. You put together a great pair, you're expecting it to mean revert or give you some production, it can still do whatever it wants to do. All you have is probabilities. You don't have guarantees, unlike some politicians that trade on information, right? We don't have that luxury. Not mentioning any names, but we don't have that luxury. We have to base our stuff on probability, on research and all that. But I really love having a data-driven environment. So to give you an example of what this looks like in production here, when you put some ideas together. I'll just show you. So this is starting out. This is my trades on just a few S&P stocks starting out. So 277,000 of capital on, 153,000 long, 152,000 short. That snapshot was taken at 7 a.m. On that day. This is the next snapshot taken at 7:30 the same day, or 7:15 actually, just a bit later. So 0.33% return on capital is what we like to see, but we don't always see it. I'll talk about my benchmarks in a minute. And this was at 10:20 a.m. hitting 0.4. So again, long dollars and short dollars equal, not playing around and getting, not doing a lot of fancy stuff, not trying to break anything, just simply taking it from the open to the close. So that's what basket trading is a lot of small size per idea. Like I said, some of my traders do 400 per position, 500 or 1,000 per position. You don't have to even be this large. But I have some guys that do 20,000 per position, so they trade bigger than I do. But it gives you an idea of what basket trading is. It's having information on a probability basis of something performing for the next time frame. I can do this. I can go back to my screener and I can choose 3 days or 5 days or 20 days and get that sort of backdrop perspective of, after we've had these kind of sell-offs, what does the next 10 days look like? All you have to do is hit explore and it will give you, tons of ideas for performance. UNH expected to it has odds of 84.6 for a 4.39% performance over the next 10 days. Marathon Oil, Micron Technologies. So that will incorporate, Micron would take 10 days, would take us right into mid-month seasonality, where we already saw the SMH expected to blossom. Ingersoll Rand, Dow Chemical, all very good performance, good odds over the next 10 days. So I use it for context. I use seasonality, and then I go in here and I look at ETFs. I take the odds on the ETFs as well. I look at that element. Then I go more granular and come up with a list of long stocks that I want to trade for the day and a list of short stocks that I want to trade for the day. Put them in for the open based on limit orders for the opening of the market. Might not get filled on everything, especially if it's something that's gapping a lot already. But what I have left, make sure that I'm hedged completely and just leave it on until the close. And you can put in orders for the closing print, which is called market on close. I'm 6 minutes over here.
No, you got all the time you want to.
So yeah, I mean, what we want to do some Q&A, or I can show some more things. It's up to you.
Well, let's see. Well, who has some questions first of all? Let's see. I asked people to start thinking about some questions they would ask. I mean, I can ask. Let me ask a couple, but please type something in the chat if you want to ask some questions. And then we'll...
Yeah, I also, while you're thinking there, it's also important to understand correlations of things. So, for example, this is a 1 year run here of just the 11 sector ETFs plus UUP and TLT as well, the US dollar and the 20-year bond. So this gives you an idea of how correlated these have been over the last year. And that's also important to, understand when something moves, like the TLT moves up, what does it impact? What does it, affect positively? What does it affect negatively? This is an example here of just that very thing. If we go to, let's see, I'll put it in the middle of the screen. If we go to TLT, so this is ETF correlations. That was updated August 13th, whereas this last one, I just ran that last one for October the 1st. But nonetheless, this is pretty accurate. So this is the ETFs that are correlated with TLT. So going down to the other end of it, you'll start to see something show up here. I highlighted them. These are all the ETFs. So there you go. iShares Financial, negative 0.42 correlation. KBE, the Spider Bank ETF, negative 0.48. XLF, right, your main Spider for financials, and KRE, the regional banking, all negatively correlated to TLT. So you have to watch your predictors. Okay, you have to look at what's happening in the US dollar, what's happening with interest rates, what's happening with your value versus growth ETFs. What are these things telling you? What is the VIX doing in the morning? So I spot check the futures at night, do my homework. In the morning, I just come and look at, the ETFs that I have, see what's changed, anything different, any new catalysts, and then go in and make those adjustments. So I'll give you an example. When TLT was selling off here, so these big downdraft days here. So when TLT gapped in the morning down, that was an indication. Even if I didn't catch it very well that day, by the end of the day, you've had a massive move in the bonds and of course the corresponding interest rates. So right away, you know that money managers are going to start scrambling to make some adjustments the next day. So there's a follow through thing. So one of the things that I did the next morning was I went long of banks, financials, REITs. So there was really a powerful move in all those groups because of the move in interest rates. Right? So we've got this inflation backdrop, we've got interest rates backdrop, things like that. So you've got to understand your predictors. If you don't have the VIX, you can use VXX as a proxy, see what's going on with that. But if that pops up significantly in the morning because of a catalyst, it's going to affect what groups are traded for that day, whether people are more defensive or whether they're more aggressive. So typically defensive is flight into the US dollar, flight into consumer staples, utilities, can be REITs to some degree, could be basic materials, and out of technology, even out of some industrials, and out of some discretionary. So you get your correlations, it's all about relationship-based trading. When something moves, what else does it move? Right? What does it impact? So we have another cool service coming out in a couple months. Well, if you read the Stocks and Commodities magazine for November, you'll see my article on that new service that's coming out too. But I can give you kind of a quick preview here. Let's see. So this is it. You'll see some of this written about in the magazine, but it's called Sympathy Trader. So when something moves like a predictor, so the predictor was the diamonds in this case, moved up 1.48%. I wanted to know what would happen the next day from open to close. So the next day was September 24th. So it told me after the diamonds had moved that much, it said to short all of these, literally short all of these Dow components. Can you imagine? it said that if the diamonds move up that much, then the next day you should be short all of these stocks. Well, I did. I took the trade, and here's the results. I took these ones short, and I hedged with the diamonds itself, and the results were 0.118% return on capital. Then I did a comparison. Had I used the sector ETFs for each of the Dow components, I would have actually done better at 0.151% return on capital. So anyway, lesson learned there. But I mean, I don't. It's pretty tough to use them all the time. So I use some of these sector spiders as hedges. But that was just an example of if I had taken every one of these trades that were suggested based on what happens the following day after the diamonds move 1.48% up, then I would have done even better by doing that hedging on each one. Anyway, back to you, Don.
Do you want us to read you some of the questions from the transcript, or would you rather read them for yourself?
No, you can read them. I don't know where to look even right now. So,
Okay, John, do you want to do that, please? Could you possibly lead the questions? Because I don't want to do everything.
Hey, Don. Yeah, sure. Masood asks, what kind of education do you offer to be able to trade this way?
so we have some education in our Learning Academy. So when you go to, let's see here, I'll show you some things inside this here. So we've got a bunch of courses like first thing you can do is everybody should kind of, this is one of our tripwires. It's Edges of Pro Traders, kind of tells you what a lot of the different pro trader stuff is. And the Seasonality Almanac Dashboard Introductory course you should do. Trading your first $1,000. This is really like if a guy's just starting out single stock trading, it's got some information there. Then a single stock trading course, gaming in theory and pairs trading course. And then we have some stuff on how to, put baskets together. And I do an onboarding session with you as well to really help you get up to speed with, just selecting a few longs, selecting a few shorts, putting them together, that kind of thing. So we have podcasts and blogs and one-on-one training, things like that. So a lot of stuff to help you. But you don't have to take a statistics course to be able to do this. You're going to be relying on the data that we already have curated. It's more about you probably putting together a little bit of thinking in terms of the macro environment and where it's better to focus your energies to get that bang for your buck we call return on capital for the day. So you want the best return on capital you can every day. And our benchmark is for the strategies that we have in the database here already. I can just rattle off a few of them. Connors or signals. These are basically signals, Connors, RSI, percent B, momentum, MFI, percent R, stochastics. And then we have seasonality, and then we even have tech patterns. So I don't want to know, whether there's a hammer. I want to know what happened after the hammer, right? I want to know what happened after the U-turn. I want to know what happened after it hit an 85 or 90 or 95 RSI. That's the whole program. It's giving you those insights. Now you just have to package together some long and short ideas, or you could just take them long and have a hedge standing by. Some days, if the market was gapping down huge and it was like the end of the move, this is like fire sale, and I'm expecting there to be a bit of a significant bounce right after the open, I might just have my spider hedge standing by, buy as many stocks at a discount that were from my stock odds, like I'm taking all the highly favored stuff, and then I'll hedge if necessary. But on some days where we've had the market be really self-correcting and rip back, haven't hedged for, half hour. It just opened down and all the stocks started to rip up. So you get to decide for yourself what this looks like. All this information is stats on the characteristics and behavior of stocks relative to the signals that they create. Like when something hits a RSI value, or when something hits a percent B value, what happens next? So
Great.
I got guys that have hardly traded in their life. They can start with Bright, let's say. They want to pursue a career. The very first place that I would start them would be here. I'd go to pairs, and I would start them within the group itself. So we'd take, for example, utilities, and we would explore right within the utility group itself, and we would sort that by odds to say, okay, you would want to be short maybe NRG, ETR, PCG, and Southern, and you want to be long NI and DTE and AE and EXEL. So there's 4 longs and 4 shorts for you, and that's the way you start, with very small size. Well, if you're long and short the components within the utility sector, right, very little damage could probably happen to you. I mean, it's better to be in electric utilities long versus electric utilities short, provided there's no hurricanes and other drama going on. But if you put some long and short ideas, you're either going to make a little bit, or you're going to break even, or you're going to hardly lose anything at all, because you're so hedged. You're so statistically efficient there, right? So that's the place to start to get the handle of how it all works, how you put your orders in, how you manage a basket, how you take it off at the close. And then from there, you want to start to open up a little bit more risk, very incrementally, very mile marker type approach. And so that's what I would do with somebody that's just starting, is kind of help them go about it very gently and very easy to sort of scale, right?
Well, great. I think that leads well into the next question, actually. Ram asks, how are we supposed to manage up to 250 ideas effectively at a time, putting it all on, taking it all off? And are there tools to manage or automate it?
Yeah, it's a good question. So when you play Baccarat, for example, you could play the player or you could play the banker, right? So most people would sit down at the Baccarat table, and if they understood the rules, the game somewhat, or they just learned about them, they would probably choose the player. And the reason is, when the player wins, the player doesn't pay any commission. When you play the banker, you pay 5% commission on your winnings the whole time you're playing the banker. So nobody wants to play the banker, they want to play the player. Well, the edge actually goes to the banker even after paying commission. So if you want your money to last longer, you choose the banker, and you play from the banker's perspective. Trading in our landscape today is similar to that. If you trade on Robinhood, you're going to have a very friendly user face that's kind of set up for turning the markets into a video game somewhat, but you don't have a lot of features. So you can't do things that other people can do. Not only that, your orders are being sold to Citadel, as you're aware by now. And that's called payment for order flow. So not only are you disadvantaged in terms of features, but there also might be other restrictions that occur, and you might not have the best pricing because your orders are being sold. The reality is this: if Citadel couldn't make any money off of those orders that are coming to them, there's no way they would keep the deal and keep paying Robinhood anything. So they have to be able to make money. So how is it that they can make money? Needs to be thought through. How is it that they're paying up to, 20 to 40 mils for all those orders? By the way, if this half penny thing goes through, that's going to cut Robinhood's Robinhood's revenue in half, because there's no way Citadel's going to continue to pay when everything's divided into half a penny instead of a penny. The reason that they can make it is because there's so much frothiness within the ability to sit in front of the pennies, the whole pennies. So my point is this: if you want to have some of these features that allow you to do this, you're going to have a broker that supports that. So if we went over to Interactive Brokers, you can sign up as the Interactive Brokers Pro or the Lite. The Lite has no commissions, but has less features. The Pro, you pay commissions and has full features. So you can do, from that platform, you can do a whole wave or a whole basket of orders at one time. You can, with one click, send them all into the market. Or you can use a spreadsheet, which most of us use spreadsheets to the API, and we send our orders through the spreadsheet right to the back end. That's predominantly how it's done. Excel is a massive tool in doing basket trading, and any full-featured platform probably has an API or would support Excel or Python, and it's a great way to manage this entire operation. If you have to do it manually, one at a time, yeah, you can probably send in, before the open, 10 to 15 orders long and 10 to 15 orders short, and you're just trading them from the open. And then once you get filled, you put in the closing order, the market on close. So at a minimum, you have to have the ability to set a market on open order as well as a market on close. So it's MOO, or limit on open is LOO, LOO, and market on close is the only thing you'd use. I don't recommend limit on close, because you actually want to be flat overnight. You want to get them off. So a market on close order can be put in right after I get filled in the morning. So I get filled on my issues, and I just click, highlight them all and click market on close, and all those orders go in for the close. And then I can turn my computer off and go do other things if I want. Those orders are going to be completed at the close, not before. So you need, in order to approach this as a career and really run it as a business, you need more features in your platform. If anybody in the group, if you have some reasonable capital to significant capital to work with, I have a great commercial rep at Interactive Brokers. She's actually originally from North Carolina. She's in Nashville now, but I could ask her to, really negotiate a good rate for you with Interactive Brokers Pro. And it's a great platform, and the only retail broker I would recommend myself. I don't trade through Interactive. I trade direct to Goldman through Ready. So, and that opportunity is there for you as well, but you'd have to apply as a prop trader with Bright, and you need to get some exams and stuff like that. So it's not the easiest. You can't just snap your fingers and join Bright. There's a process there, but you can certainly snap your fingers and join Interactive Brokers, and I can help you. So just email me. Don, I'm going to do something. If anybody, any of your group, just because you guys were so hospitable to me back in 2013, and now again, this invitation to talk to you is really kind and very generous. I'll send you a link if anybody wants to subscribe to our stock odds resources. That I'll give you a discount on that. I'll have my admin make up a discount code for you guys.
What kind of
So
dollars are we talking about overall, just for people's perspective?
the one that I would recommend would be the advanced. That gives you the full web screener. It gives you all the dashboards. It gives you all the education and stuff like that. And it's a purposely, purposely discounted. So you're talking about 2 months for free, $99 a month thereafter. So
After the discount?
yeah, so like you get 10, you pay for 10 months, you get 12 months. So $990 for the year. And then I'll give you a discount off of that just for you guys, which would be another 10 or 15% off. I'll see what I can do. So that gets you access to the stock odds, resources, education, data, dashboards, things like that. So if the seasonality is there for free anyway, you can get that, no problem. But if you want more than that,
Absolutely, we'd be delighted to pass that along to people.
yeah, we'll just, trying to help out, and our prices are going to go up. Just so you know, if you go to our website, you can't actually purchase anything. I'll show you what I've done here. So let's say you go to pricing and you want to go to advanced. So you see the price, right?
Uh-huh.
Do I qualify? You have to actually email me and make an appointment with me. Nobody can subscribe to our data unless they meet with me personally. And the reason for that is I only use stock odds data for my trading every single day. And not only that, my traders do as well. So this is an invitation into our life, our tools, our resources. And so it's not available to anybody. If somebody is like a mobster on Wall Street bets and is just there for, the FOMO or whatever, I'm not interested, sorry. So this is about a career. This is about being a professional trader, ultimately, whether you're retail or you join a prop firm. But I only want to work with people that I actually like.
And I
So,
think John has some more questions, but let me ask first. You mentioned IB for those who want to try something like that first, using IB as a broker, or IBKR if you prefer.
yeah. Mhm.
And what kind of account size did you say that would be a minimum?
Well, I mean, you still have you can put any account size. You still have the pattern day trader rule there, which is regulatory, right?
Right.
So
It's just
that's
25,000.
right. I mean, you can trade with 5,000 or 2,000, doesn't matter. But I'm just saying, if you have a reasonable amount of capital, then I'll talk to my commercial rep. I would say more than 25,000. If you have that and you want to talk to the commercial rep I have, and she'll get you set up, and help you and negotiate a good rate for you. So
Perfect. That's what I was wondering. There's actually, how many questions, John, do we have left?
Well,
like
I was going to say, Rob,
she's like
you,
really good friends with Thomas
Oh,
Peter Fry, I mean, so I mean, Interactive is a great company. They do their best they can, and I'd recommend them wholeheartedly. So I'll refer you to her, and then she'll talk to you and negotiate with Thomas about a good rate for you, and away you go.
fantastic. John, you were going to
yeah,
say?
yeah, Rob, you kind of alluded to it, and there was a question from Troy. Can you explain the process for becoming a prop trader at Bright? Do you offer training courses? And I think you answered that earlier. And then a follow-up of what are the monthly recurring costs of becoming a prop trader, data, info,
Right.
etc.
So Bright Trading's at stocktrading.com, and I've got it on the screen here now. So steps to join. So basically, we're not taking anybody from Massachusetts because we're not registered there, but other states are okay. The Nevada has more licensing required than the other states, but so most states would just simply have the Series 57. So you need to do the SIE, which is the basic stuff. It's called the Securities Industry Essentials. It's 75 questions with 10 bonus questions. And then after you pass that, you can do that one on your own. You don't have to, get with us and fill out all the paperwork. You can just go to finra.org and you can sign up for the SIE yourself. The best place to get study material would be passperfect.com for the SIE. And then you need to, once you get that out of the way, then you need to register for the Series 57. And therefore you do need us, because we're the ones that open the window for you and process you as a member. So you can't take the Series 57 unless you have a sponsor. So we're your sponsor. And then once you pass that, that's when you would put in a small risk deposit to trade with us. And like I said, I can take people as low as 10 grand now, and our minimum used to be 50,000 only a few years ago. It's because of the success that I'm seeing, with people, especially through this more quantitative approach, and not really letting them just do anything they want. Here's a structure, here's a framework, let's go forward. So we do have a kind of a mentoring group within Bright that you can kind of pick up a lot of day-to-day stuff. So it's worthwhile if you want to make the journey and the hassle of getting your exam completed or exams. It's not fun. It's a barrier to entry, but if you want to do it, then what happens is you're not trading with your 10 grand or 15 grand or whatever. You're trading with the house money. And we give, it's 30 times without permission, but I give 50 times, sometimes 75 times, so there's a lot of capital. We have a lot of unused capital in the firm every single day. Capital that's not used. So we're looking for more traders for sure. But barriers to entry. So anyway, you can fill out the questionnaire. Just when you go to the questionnaire here on the stocktrading.com, fill that out, and how did you hear? Just say, this meetup group here, and that's how you heard about it. And I'll get somebody to look after you, get you paperwork and all that kind of stuff. When you do the Series 57, I think Knopfman is the best resource for the study material. Past Perfect, not quite as good for the Series 57. So it's better for the SIE. So there's a bunch of costs. Like you've got to pay for your study material, and then there's a bit of money that goes with your paperwork and processing, open up the window, FINRA gets some money. So, it takes a little bit to get in the business. And then once you're in, there's ongoing costs, like you pay for your platform. It's $175 a month for the Ready. You pay professional exchange fees, $35 for New York, $29 for NASDAQ. You might pay for some additional charting or something if you want. So you're going to have some overhead in your business, right? Anyway, if anybody's interested, the place to start is just fill out this questionnaire that's on the stocktrading.com website.
Great, thanks. There was a platform question about stock odds from Matthew. He asks, does stock odds have dry run functionality? In other words, sort of an option to invest imaginary money and track it, see how you would have done, etc.
It doesn't, but it's really easy to do with Google Sheets. And I can send you, a webinar that we did on how to use Google Sheets. So we're modeling stuff like daily that we're not in. So you always want to be modeling before you go into production. And then when you go into production, make sure you're doing some models that are not in production, because what happens is the regime can change. So for example, how the market is functioning, and how groups are functioning can change over time. And when you get those regime changes, sometimes if you haven't been running other models, you might go, what do I do now? If you've been running other models, you might see that all of a sudden a different strategy is starting to leap into the forefront, and the one that you're currently in production on is declining slightly. And so this leapfrogging happens once in a while. So I always recommend be in production on a particular strategy that you've come to grips with, and also be testing other things.
Great.
And I mean, Interactive Brokers, for example, has, you know, demo mode. You can actually do some stuff there too before you even start, I would think. But yeah, it's so easy to do, especially with any strategies that are open to close. You can have a whole bunch of stuff, you know, running and see if you were, you know, right on it, and no harm, no foul, right? You're just testing. So it's very easy to do.
Cool. One question I had, let me see. So you just mentioned the idea of sort of like a regime change and kind of pivoting on based on the data for different strategies, maybe. Using stock odds, it seems like you know, you're looking at all of the stock odds data. So here we are, you know, October 4th, we're looking at all the stock odds data of the past 9 or 10 years, I think you said. So does stock odds itself have a way for me to say, go 5 years back?
Yeah, well, you can choose, so you can do your look back period, right? So 2000 days, 500 days, whatever you want, or you can actually just go to any day in the past and go, all right, I'm here's May 5th. I want to explore May 5th, and boom, there's all your data for May 5th, and you could, you know, see what happens the next day. So it's so easy to go back and especially look at certain events that happened, certain down days, you know. It was totally amazing during 2020 sell-off at how many things, you know, were just bang on with the odds, even in spite of, you know, unprecedented disruption, really. So it's been interesting. And some of those things do skew the data statistically to some degree, right? But people always ask me, well, do you have earnings data in here? Do you have like things like that? Well, because it's so price-based, everything gets factored in at the end of the day. Let's say a company had great earnings and it popped up 5%. Well, it's going to become one of these events that was up 5%. Now, not directly related to earnings, but it was up 5%. What happens next? So I have that data. So everything at the end of the day becomes price. And we have signals on that action and subsequent odds. So if you want to, you know, if you want to filter the data, this is a screener. So you can choose stocks or pairs or every stock versus the spider. You can choose your watch list, right? So you can do stocks, you can do, say, S&P 100, or you can do the Russell 2000 or the sectors that you want. So you get to choose that. And then you can say, you know, do I want daily data, weekly or monthly, you know, your look back period. You can choose the date, obviously, that you're working from. You can choose price range. So, you know, maybe you want to go between 10, you're just looking for stuff between 10 and $50, right? You know, some low price stuff, or 5 and 50. Or maybe you want to do like I do. I normally do from 10 to 2001. And then you choose your volume. So you're going to be screening out stuff. And then you choose your minimum events. If you're looking for price discovery, those things that are like crazy sort of one-off things that happen with stocks, especially in the Russell 2000 and the microcap stuff, you ended up, you want to screen for like one event. So you can do price discovery. Here, let's look at streaks. They're easy to understand. Something that is streaked in one direction for a while, right? Let's look at in the S&P 1500. How much is streaked? So this is representing days in a row in the same direction. So Edwards Life Sciences had 7 down days in a row. Align Technology, 7 down days in a row. Crocs, plastic shoes, 7 days in a row, right? So on the other, that's down days. Let's see what's been up during the same time. Banks. Remember I said I was been long banks, right? And still, this bank's been up 6 days in a row, and the odds are still favorable for it to be up again tomorrow. Fabulous. So the data's there. It's very helpful. You know, but with this one, there's only been 3 events in the past where it's been up 6 days in a row. So it's not a huge sample size. So that's what I'm saying. You get to decide whether you're going more for the noise side of the business, where you have a lot of samples, or you're going to focus more on the signal side, where you have less samples. To have a higher degree of safety, you probably want more samples. But there's nothing wrong with, if you guys are single stock traders and you don't want to do big baskets, use this to, instead of flipping through hundreds of charts, use it to find those signals, those events, those things that happen fairly rarely. We can look here at this one. UCBI is had a streak of 9 days up in a row, and it's looking to be down. Let's go take a look at it. UCBI, interesting. Oh, it's not coming up in FinViz for some reason. Well,
You said UCBI, you typed UBCI.
am I dyslexic? I think I'm dyslexic. There we go. Okay, so there's the streaks. So the red candle doesn't mean it's a down day. It means everything's based on close to close. So it actually closed higher than the day before. So it counted for still part of the streak, right? So that's interesting. But you know, that started to change there when the interest rate component kicked in, right? When the taper, you know, mid-September, we started to have more concern about the taper event, right?
Yeah, totally.
So, you know, I would never found this by flipping through charts, because first of all, I'll tell you a secret. I never look at stock charts other than when I'm talking to somebody else like yourself. I never look at stock charts. Never. I never look at, I might trade 200 symbols, and I don't have any idea what the charts say at all. Charts are very deceptive. They're very misleading, and people are drawn into the seduction of predicting what's going to happen next. So our odds are based on the statistics that have happened and the probability that that's a repeating situation. We're not trying to figure out what's going to happen next like most people do with charts. So I would rely. In fact, we ran a contest in stock odds. We recruited 10 chart readers that are pretty good at chart reading, and the details are on our website here in terms of what we actually did with them somewhere. Let's see, down here somewhere. Forgot where they stuck that thing. When you got other people running your show here, forget where they stick things. But anyway, it's on there somewhere. And we did 10 technical traders, chart readers, 10 symbols per day for 10 days, and to see who won. And stock odds beat them. And stock odds had to choose 5 longs and 5 shorts just from the data. We couldn't consider any macro. We couldn't consider anything pre-market. It was just simply the odds. And it still beat the chart readers. So anyway, just letting you know that there's a lot of education on how to read technicals and charts, but at the end of the day, I don't see it as compoundable as people like try to lead you to believe. So you guys might be good at it, I don't know, but historically I just don't see it as compoundable as the educators in that area tend to say. So
All right.
any more
Well,
questions?
Yeah, I think that did it for the questions. Anybody else has some, please use your microphone or type it in the chat.
Ross, were you indicating earlier that you had some questions? I think your mic came on, or was that an accident? I don't know. And I guess the real question is, in my mind, it's very difficult with these services and with data services and with past results. And I assume that you yourself have used this data and used it very successfully. But given that you know the overall framework, you know the relative strengths and weaknesses of the different indicators, and you know the whole probabilistic behavior of, you know, how choosing something usually works out, how long would it take somebody who does not have the background you do to gain enough familiarity with this tool to actually be able to use it to advantage?
Yeah, well, it can start early on in terms of being a help. Like it can help you
Sure.
right away just to say, look, if you know, maybe you think that Facebook is supposed to bounce tomorrow, right? Because it was down so much, and you're tempted to go in and trade it. You might look at stock odds and it might have a different approach. You might say, you know, the probability is that it's going to be a week again for the next day. And that just right there can keep you out of trouble.
Sure.
Or let's say the opposite. Maybe it has odds of being up a lot and you go, you know what, this is great. I'm going to take a little bit at the open just to get information. And I'm going to, if it pulls back, I'm going to look for that opportunity to buy that discount, knowing that stock odds says that from open to close, it's still expected to be an up day, or over the next 3 days,
Okay.
it's expected to be really up. So I have some option traders, like we don't have options in here, but they trade options only, but they use it for context, and for especially what they do is use the 10 and 20 day one to get that real perspective, that real backdrop on how much decay they might be facing, or whether they want to do a calendar spread or whatever, right?
Well, actually, that opens another area that is very important to a lot of people. This group are option traders. And so you say would you consider taking option traders at all?
I would, as long as, you know, they're of the mentality that they can understand a statistical approach, probability basis for it, and that they need to find a way to make it on the aggregate. Because, you know, I could go to my dashboard, you know, and select, close my eyes and select, you know, one symbol. Let's say we're doing here's an example. We're doing a 20-day on the Bollinger Band, which you might be using for options. Or this is a 10-day, sorry, this is a 10-day return. That's perfect for a sweet spot for option trading. So you say, okay, I'm going to take, you know, Shopify here. So it's got, you know, great odds of being up and good performance. It hit the, you know, lower Bollinger Band almost there. So you just select that one. Well, maybe that one doesn't work out, but in this list here, maybe 6 or 7 of the 10 did work out. See, that's where the whole approach to basket trading just makes such a difference, because I don't have to be right on one symbol. I'm right on my aggregate.
Yeah, I think any good option trader would be, well, a lot of them aren't, I guess, but anyway, that's a good point. How about somebody that had their own system for trading? To be honest with you, a lot of them are concentrated. In other words, a lot of the strategies, broken wing butterflies, calendar spreads, etc. People tend to trade them in just the Russell, just the S&P, whatever. Um, Assuming they have highly mitigated strategy that has all sorts of protection and they have statistics, either historical or simulated or real, would you consider allowing people to use other systems not included in your own repertoire?
Oh, sure. I mean, and that's the thing is, absolutely. If you can make a request and we can add a feature or something, that'd be great too. Something that's useful for options traders. But yeah, you need a lot of sources these days because look, I mean, information is king. People have to be informed, they have to have insights, and it's tough. Trading is tough because it's extremely efficient and it's extremely predatory in a lot of ways. There's people far more informed and with different agendas. So anything you can do to support yourself. Stock odds is just supposed to be, another
Sure.
resource for you, right?
But how about Bright itself? Like supposing you had your own strategy that you'd already fully developed that didn't need any additional inputs. Would you consider accepting that on the Bright side?
Well, I mean, for Bright Trading, we're primarily an equities trading firm, so not options. We do allow purchasing options, but not writing options.
Oh, I see.
But you also have to have 100 grand in your account. And the reason is options are leveraged, right? And we're giving you 30 times leverage. So 30 times 10. I mean, people can get pretty carried away. And also we don't want to have to police the options that way. So
Sure.
so basically just consider Bright to be an equities firm.
Okay.
Now, we have traders at Bright that also trade options in their retail account. So they just keep their retail account, do some options there, and then they do their equities at Bright.
Okay. I just want to understand.
Mhm.
And how about volatility trading? Have you like things like VIX and so forth? Do people get into that at all?
Well, I mean, you always use the VIX. I mean, most of my traders have made, more money when the VIX has been above 15 than below 15 in
Sure.
general terms, right? So we're always using volatility every single day. And
Okay.
we use ATR as a metric on individual stocks for a measuring stick of how volatile they are too. So a lot of volatility modeling. And I have after hours traders that trade baskets as well. So I've got one guy that trades just in the afternoon, the extended hours trading. He trades 13 million shares a month just in the afternoon. Yeah.
And how much consistency is achievable? In other words, obviously your firm is making money, which is a huge tribute to the obvious success, overall success for the firm. But do you have traders like commonly, let's say, losing 20% of their account in one month and gaining
Yeah,
20% the next?
we have had we've had the odd person like I usually a red flag when somebody all they want to talk about is leverage. How much leverage can I get? How much leverage I can get? We've had a few people come in like that and kind of take some shots once in a while, but we do have good risk modeling and we talk. We don't automatically liquidate. We always talk to the trader. And I had one guy today. He was down. He has plenty of money in his account, but he was down about 160,000 today. And he just got pot committed kind of when he shouldn't have. What he did was he had overnight baskets on and he took them off. He took them off profitably at the open, and then he decided to do something outside of his normal game plan, and he got pot committed, and he was down about 160. So I just worked with him a little bit. I just said, okay, listen, let's not add any more, but every time it rallies, let's reduce a little bit, and then I'll let you rebuy those positions on a pullback, and then you can sell it again. And anyway, he
Okay.
only finished down 55,000 today, which is a small amount of his account, but like the 160 was definitely a lot more.
Okay, well, there are some other questions here about details of costs and so forth, but I guess the people can mail you. Well, somebody is asking about the cost of the courses themselves.
Yeah, well, I mean, the best way to get signed up is just to do the advanced package.
Okay,
So I would prefer that if it's right for the person, just you can book an appointment with me, and we
sure,
can go over it again and just make sure it's a good fit. That's all I want. I don't want anybody spending any money on something that's not right for them. You know, I'm not after eyeballs. I'm not after drawing people in and sucking them into something. Like I said, I use it every day myself. So I'm willing to share some insights and help other people. And I'll do the best I can. I can't guarantee success for anyone, but we can certainly increase your odds
for sure,
and help you preserve your capital and build a better mousetrap. Because what if the market stays sideways for the next 10 years, or worse yet, we drop 30 or 40% from here? People are going to need to have more tools and more tricks up their sleeve, and learning how to hedge trade is really important, I think. So,
oh, you bet. Well, we better let you go because you're running a firm there and you're trading money and everything else, so I don't want to keep you an
well, I
unreasonable
appreciate
amount of time.
all the questions, and yeah, it was good to talk to you guys, and it was kind of fun to bring up that previous presentation, and I mean,
Yeah,
not
it is.
not much has changed in 7 years, really, and we've expanded on this statistical side more so, and it's paying off pretty well. So,
Well, that's a huge venture, and we wish you every success with that new statistical program. And yeah, please send me that information, and I assume, well, yeah, we'll get it out to our members, and we can include Aramer, I think. Can we? The broader trading community? Well,
yeah.
we'll just put it out as ours, and if they want to ask you, they can.
Yeah, sure. Yeah, I'll send you some information, and yeah, I mean, I think the way to start is if you have anyone really interested, let me meet with them and see if it's right for them, and away we go.
Super, thank you so much. We'll continue, we'll have a little discussion in other areas
Sure.
offline here, but I'm
Okay.
going to stop the
Well, I
recording
know
now.
you have other meeting stuff you wanted to cover too, so I
Well,
better let you go do that. So
okay, so we'll do that. Thank you very much. We
here,
really appreciate it and best of continued success.
yeah, you're welcome. All
Thank
right, you guys, take care.
you. Bye.